Welcome, everyone. I'm Michael McCloskey, founder of GreensKeeper Asset Management. And it's my pleasure to welcome you to our 14th annual meeting. It's nice to see some familiar faces in the crowd, some of our current clients, and some new faces as well. I'm going to mix it up today. Today's going to be very different than our past presentations. Today I'm going to spend more time focusing on specific investments and portfolio holdings instead of talking about the firm and our investment process. I'm happy to schedule a meeting with people in the audience who may not be clients and don't understand our value investment process. So reach out to me afterwards, and I'm happy to schedule a private meeting and get into the nitty gritty. So a famous value investor once said that value stocks are about as exciting as watching grass grow. But have you ever noticed how much your grass grows in a week? So value investing works, but I would say that most people are not well suited to pursue value investing. Only 5% of the people in the investment community actually use this style. And fundamentally, it comes down to temperament. You have to be disciplined. You have to be very patient as to when you invest. You got to put in the work. And so I think for most people, it doesn't click with them. For Michael and I, we have the right temperament or makeup to put the style into work, to work for us successfully. Now this slide here is an excerpt from my last annual report, and it tells about the story of GreensKeeper and why the firm exists. So after 15 years on Bay Street, after 2 successful careers, the first in law and the second in investment banking, after taking some time off, I decided to start managing my own money. And then my mother and father, who are in the audience, were kind enough to give me some of their money to manage. And then my brother and sister gave me all their money to manage. And then some friends approached me to do the same. And so the reason I created GreensKeeper was really as a vehicle for other people who were interested in having their wealth managed the same way that I manage mine, using our value investing methodology. And on this page is a great quote from a famous value investor in France, Jean-Marie Elevard, who once said, "I would rather lose half our clients than lose half our clients' money." And that's the way I think about it. That's the way our team thinks about it. We are stewards. We take this responsibility very seriously, and we want to compound your capital and ours prudently to make sure that we don't go backwards. And you can see that our firm started with a whopping $3 million of assets under management some 14 plus years ago, and we've grown every year, steadily, and the last 5 to 6 years we've accelerated our growth. And you can see originally the dark bar at the bottom is the value fund. That was the only product that we had. We didn't accept separately managed accounts until about 5 or 6 years ago. And since then, we've taken on clients from the US and the UK, and some clients want a special mandate where they want something specific in their portfolio. So today, that's been the biggest growing portion of our portfolio. At year end, we were at about 167 million of assets, and we're still a boutique asset manager, and we're going to keep it that way. I know most of our clients, almost all of our new business comes from referrals from existing clients. And Charlie Munger once said, the best way to get new business is to deserve it. And so we're going to keep putting our head down every day to make sure we deserve your business and your additional referrals. And so as the firm has grown, so has the team. My brother James, in addition to being the photographer for this evening, has been with me from the beginning. I call James the human magnet. He's done a great job of telling people at the club and elsewhere about the firm and what we do. Many of the clients in the room will know Michelle Tate, who's been with us since 2017. And Michelle deals with client questions and onboarding and getting funds transferred and helping me with compliance and running my life, frankly. So she's been a godsend since she joined us 8.5 years ago. Michael Van Loon is our financial analyst. You're going to hear from him in a little bit. Michael was a graduate of our summer program. I run a summer internship program. We've had about 9 graduates. Another one, Parker's here tonight as well. After Michael graduated from that program, he went back to Ivy, finished his HBA. He's currently writing the CFA Level 2. And after 2 years at GreensKeeper, we're going to apply to have him licensed as an associate portfolio manager sometime later this month. And I think it's important to note that we're all clients of the firm. It's interesting. Like my wife and I have 100% of our investable assets. It's about 70% of our net worth invested alongside the clients. But Michelle and Michael independently, a couple of years after they started working, approached me without any pressure from me and asked if they would be allowed to invest with us. And I said, of course. And so they both put all of their eggs in the GreensKeeper basket. And even beyond that, they both independently also approached me to say, would my mom and dad be allowed to invest here? So I think that speaks to, we believe in our mission. It's not a guarantee of results, but it guarantees that we're going to focus on what we're doing because we have people that are really, really important to us in addition to all of our clients. And we've got our money alongside yours. So I think it shows that our interests are aligned with yours. And beyond the people that you see on this screen, there's a big team behind this. My sister Jacqueline, who started consulting for the firm, I guess just over a year and a half ago, with just a few projects, but as the firm has grown bigger and bigger, I mean, the projects are non-ending. I don't know if she's working full-time now, but it's getting pretty close. So it's been wonderful to spend time with my sister, and thank you for the help. So I'm going to talk a little bit later about some of the projects she's working on and things that we have to announce about GreensKeeper. And beyond the core team, we have we're big believers in embracing technology. We have portfolio management software. All of our network is in the cloud, protected by high-quality service providers. I don't want to have a lot of employees at GreensKeeper, but we hire top-quality law firms, auditors, fund administrators. So they may not be on the screen, but to know that we have systems and people behind us here. And then finally, I was asked a question by someone, a client who couldn't make it tonight, and his question was, well, you're in Canada and you often invest around the world. How do you get a global perspective? And I would say, in addition to reading the financial press, Financial Times, Wall Street Journal, The Economist, I've been fortunate enough to be involved in a community called ValueX for the last 12, 13 years. It was started by Guy Spear in Switzerland. I'm one of only a few Canadians that get to go to this, and it's 150 of the smartest people I've ever met. They're all value investors, and they do this in different parts of the world. They're from Saudi Arabia and Turkey and mostly European and Asian. So that network I talk to on a monthly basis. We get together and talk about stocks. If Michael and I are going deep on a particular name, we've done this a few times, we'll reach out to the network saying, does anybody know this company? Does anyone own it? And so we'll have side discussions or calls. It's an invaluable network that we can leverage to try and get a better understanding of what's happening with these businesses. Okay, so I'm going to talk about value investing, but first I'm going to talk a little bit about what is not value investing. Back in 2021, I wrote in one of our quarterly scorecards about this couple. I've got to remember their names. They were. What is it, Jackie?
Chad and Jenny.
Chad and Jenny. So they were on TikTok. This thing went viral. And they were telling people how to invest. You know, they made 2,000% return in 1 month. And they give you a sneak peek of their top trading strategies. So why don't we roll that? Here you go.
So how do we make money from home? For starters, this is not a sponsored video. We just get this question all the time, and honestly, the answer is really simple.
So basically, I just trade stocks on an app called Robinhood, which I left a link in our bio if you want to check it out. It's free to download, free to sign up. They actually give you a free stock, so they're paying you to sign up. But again, not sponsored. And I know trading sounds intimidating. Here's my strategy in a nutshell. I see a stock going up and I buy it, and I just watch it until it stops going up, and then I sell it, and I do that over and over, and it pays for our whole lifestyle.
Welcome to the TikTok generation. Charlie Munger once said, the world doesn't run on greed, it runs on envy. And there's nothing more psychologically damaging than watching your idiot neighbor making a lot of money. I mean, you know it's dumb, but there's a part of you that wants to do it. So I thought, I wrote about it 5 years ago, and I said to my sister, why don't we actually check in on them and see how they're doing? And so back in 21, we said we don't usually do the over-the-counter markets, but we think Drone Garter has the beans. Go, 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 Drone Garter. We lost a ton of money. You don't hear that part. And Jackie told me that they dropped their social media account. So remember that when you're watching some of this nonsense on social media. Okay, so let's forget about the amateurs. Let's go to the professionals who are on CNBC and see what they have to say. This is from October 2021.
So, well, Upstart's up about 25% just in 4 days since we bought it. We bought it on about 4 days ago. So that's actually made a nice little move in the short term, probably a little extended right now, but longer term, that's a good looking name. Very powerful, very strong earnings. These stocks are
What do they
acting
do?
really
I don't even
well.
know them. What do they do?
Excuse me?
What does Upstart do?
Well, I'm sorry.
What kind of company is it?
Yeah, I'm not. You're breaking up.
Oh, well,
Sorry
I guess
about that.
we've got an audio problem there, Mark. I'm sorry. I do know MGM, I do know Tesla, and I do know AIG, but a 25% move in a week is pretty good for the company Upstart.
That constitutes financial advice in this day and age. Michael and I aren't trying to be incredibly smart. We're just trying to avoid stupidity, and there's a lot of it going on over the last 5 and 10 years. So we just try and stick to things that we understand. And so the question that the host, Tyler, asked, what do they do? And Michael and I are going to talk about two of the businesses that we own and what they do. And after we'll show you our entire portfolio, we can talk till the cows come home about any stock in our portfolio. But I'm going to start with probably my favorite stock in the world, Visa, the credit card company. And I suspect that pretty much everybody in this room would probably have one in their wallet. I suspect you've also used it at least one time this week, so thank you for putting some money into our pocket. But I don't know that most people have actually thought about how it works, how Visa actually works, how they make money, and how the network works. So I'm going to give you an example. Let's say you go to Lululemon and spend $100, assuming you can find something there for $100. What actually happens? So you go to the merchant, you go to the till, and you put your card in, or you tap it using the point of sale device there. Then Lululemon's bank or merchant processor will route that message. What it's really doing is taking the information on your card and the transaction information and routing it to the network, in this case Visa. And Visa is then routing that message to the bank that issued your card. In my case, I bank with Scotiabank. So it'll find my bank. No matter where I am in the world, it's going to contact and find my bank. That bank will approve or deny the request almost instantaneously, and then send that message back through the credit card network, through the merchant's bank to the merchant. And so you're sitting at the till, and within a few seconds, you're going to get a yes or no. It's usually yes. And while that's happening, concurrently, Visa is checking about 5,000 data points. Do they have their card present? Is it consistent with their past spend? Could they physically be in that location? So what they're trying to do is mitigate fraud. So that's one of the things that Visa does. They use tokenization. When you swipe your card nowadays, a lot of the time, your card number is actually invisible to the merchant. There's a one-time token that you're given that's given to the merchant and goes and gets decrypted throughout the network. It's another way that they try and mitigate fraud. And so when you look at the economics of the system at the top, if I go to Lululemon and pay cash $100, that merchant keeps the $100. But if I use my credit card, on average, they're going to pay about 2.5%. It depends on the merchant and the category. So retailers, while they accept cards, they do so a little bit begrudgingly because they're funding this ecosystem. So of that $250, who gets paid? The issuing bank, Scotia, gets the bulk of the economics, almost $1.88. Does anybody, can you guess why? The issuing bank, in my case, Scotia, we get the bulk?
They take the risk?
Yeah, they take the risk. So if I don't pay my bill at the end of the day, they're extending credit to me. But also, if my card is stolen, I can call my bank and say, somebody took my card, reverse these transactions, and they will do that, and they're going to bear the risk of fraud in that situation. So the person who gets the next most of the economics is the merchant, bank, and processor. They get about 40 cents of that transaction. And the reason is, I think the perfect example is an airline. Tim, we took a trip out to the East Coast a few years ago with one of our friends insisted on going with some fourth-rate airline, let's call it. And jokingly I said, well, let's hope they don't go bankrupt before we fly. And sure enough, they went bankrupt before we flew. But the good thing is we put it on our card. And I called my bank and I said, the merchant didn't deliver the service or the goods, it doesn't matter, that were promised to me, charge it back. And so within 24, 48 hours, I'm going to get refunded my money. But ultimately, the merchant and the merchant's bank is on the hook for that. And if the airline is bankrupt, the merchant's bank is going to eat that loss. So they do things like they make sure there are deposits on file, but from time to time they get hurt, which is why they take the bulk of the next largest slice of the economics. And then finally, the credit card network sits in the middle and takes a measly 22.5 cents of that transaction. And it doesn't sound like much until you think that they do 640 million transactions a day. And many transactions are a lot bigger than $100. So fundamentally, Visa is a switch. They're going to route messages back and forth to approve transactions and to settle those approved transactions. They're also a referee. They're the rule maker in this ecosystem. They determine how much merchants are charged and then how those economics are apportioned between the different parties in the ecosystem. So fundamentally, Visa doesn't take credit risk. I think that's a misconception that a lot of people think. It's the banks on both sides that take the credit risk. Visa is just a router, in effect, but it's got immense scale and immense brand. Warren Buffett once said he loves businesses that could be run by a ham sandwich. Visa could be run by a ham sandwich. It's such a good business, you almost can't mess it up. And so you've got 4 billion branded cards around the world with Visa, 150 million merchants. If I gave anyone in this room $1 billion, if I gave you $10 billion, I would argue you couldn't compete with Visa. To try and replicate that, it's been built over decades with all these different merchants. I don't think you could do it. And same thing with Amex and MasterCard. They've been built up over years. And even if you could, I don't know why a consumer would be better off. Visa could undercut you. The next million transactions they process, the cost to them is almost zero. So if they wanted to fight a newcomer with a price where they could, it's one of the best businesses I've ever seen. It combines several competitive advantages that I think are practically insurmountable. And so they don't compete on price. Where they compete with MasterCard and with American Express is to get banks to issue their cards. That's where they compete. And from time to time, some issuers like Costco, you probably read in the paper that from time to time they put their contract out for tender. Different banks will partner with Costco to try and get the best economics from the credit card networks. And the way that credit card networks incentivize them is by rebating a portion of their economics. So that's really how Visa and MasterCard compete. Now, I've simplified it to some degree. Payments are actually really complicated, but I've given you an idea of what's involved. Michael and I have studied the ecosystem. I've studied payments for a long time, and the best parts of the payment ecosystem are the networks themselves. We own Visa, we own American Express. In American Express case, not only are they the network in the middle, they're also the issuing bank. So there is no Scotiabank. American Express actually issues me and anyone else your American Express card. But there are other parts of the ecosystem that are quite interesting. The merchant acquirers that I talked about provide some credit. We own a company called Fiserv in the portfolio. So they can be good businesses. They're not as good as Visa, but they're pretty darn good. And if you were at the annual meeting last year, I think someone asked me, have I missed it? And have I missed Visa given where the stock was trading? And last year was trading at about $260. So the one thing I'll tell you about Visa is economies grow at about 2 to 3% in mature markets. But that's in real terms. When you add inflation, you got another 2%. On top of that, we're using cash less and less. So credit card payments are substituting for cash payments. So that gets you to about high single-digit growth rate for Visa. But also, their expenses grow slower than their revenue. So even though they have operating margins of north of 50%, they're going higher. So net income is growing even faster. And the business doesn't take a ton of capital. So with all that cash flow they get, they buy back their stock, which increases their earnings per share. So year after year, not every year, but this company grows at 11 to 15%. And I've owned it since day one. Michael and I have added to it a few times. 4 or 5 years ago, there was some concern about potential competitors. And I came to a different conclusion and we reloaded. I think our average cost base is $108. And I hope I'm up here 10 years from now talking about Visa probably over $1,000 a share. So with that, I'm going to turn it over to Michael. He's going to talk about another one of our holdings. There you go. Slide. Oh, I'm sorry.
Hello, everyone. I'm Michael Van Loon. I've been an analyst at GreensKeeper for about 2 years now, 2 years next week, and I'm really enjoying my time here so far. I'm going to now walk you through a company we've owned in the value fund for close to a decade now, S&P Global. Well, you probably recognize the name Standard & Poor's, most famous for the S&P 500 index these days. They actually make the bulk of their profits from their credit rating division. They are the largest credit rating institution in the world, and they provide these credit ratings for corporations, government entities, and on individual debt issuances globally. And these credit ratings, they provide a lot of value to both debt investors and to debt issuers. On the debt investing side, S&P has been providing these credit ratings since 1916, and over the past 110 years or so, they've assigned credit ratings throughout multiple wars, pandemics, recessionary periods, expansionary periods, pretty much any economic scenario that you can imagine. And bond investors have used this data that they've generated over time to try and establish both the absolute and the relative probability that an entity is going to default on their debt over the lifetime of a bond. So, for example, if you are a bond investor and you are looking at a company that S&P has assigned a BB credit rating, you will likely in your research, when you're trying to determine what price to purchase the bond at, go back in time and see, okay, well, how often has a BB rated entity gone bankrupt? And does that increase in different economic scenarios to really determine what yield you're going to require to manage the risk that you're giving them when you're investing, the credit risk in that bond. Importantly, these credit ratings are globally recognized so that if you're investing in, say, a company in Canada with a B+ credit rating, they will have a very similar credit risk or credit worthiness to a company in Europe or Asia. And on the bond issuing side of the equation, bond issuers, or the company that are raising the debt capital, they really value the credit ratings because of the acceptance they have with bond investors. So imagine you were walking into a bank, because it's very similar to the personal credit market, where if you are walking to the bank and you tell them that Van Loon's credit rating agency is giving you an A+ credit rating when you're looking for a loan to buy a new car, a new house, that is not going to mean anything to them. But if you walk in there and you show them an 850 FICO score, not only are you probably going to come out of there with a loan, but you'll probably have a lower interest rate on that loan compared to someone else who went in there with either a weaker credit rating or no credit rating at all. And the institutional debt market works in a very similar way, where not only does having a rating from S&P Global increase your access to debt, but on average, a company will have about a 0.5 percentage point lower interest payments per year on that debt. And for companies that have billions of dollars in debt outstanding, this is very material and well worth the slightly under 0.1 of a percentage point it costs to have a rating from S&P Global. And this dynamic between the debt issuers and the debt investors really creates sort of a network effect around S&P Global's rating segment. Because the debt issuers, they only really care to pay for debt ratings from a rating agency who has wide acceptance amongst investors. And investors only really care to use debt ratings from a rating agency that has decades of experience rating different debt issuers. So this makes it very challenging for any new entrants to come into the market and take any meaningful sort of market share, as it's challenging at one side of the equation without the other. And this has given S&P a lot of pricing power in their credit rating segment. Over time, I think since about 2007, they've raised the price of their ratings by 3 to 4% on average per year. And importantly for shareholders like us, this incremental revenue mostly falls directly to the bottom line. And they finished last year in the rating segment with incredible 63% operating margin. Well, this segment consistently grows at a high single-digit pace over time. It is a cyclical industry just due to the nature of debt financing. When credit markets are tight and interest rates are rising, entities around the world tend to issue a lot less debt. When interest rates are low and debt is easy to come by, the level of issuance can increase quite dramatically. So we've used this cyclicality at GreensKeeper to sort of find opportunities to invest in the company at attractive valuations when we think the market has been overreacting to kind of short-term earnings fluctuations in the company. I mentioned earlier, we've first bought shares in the value fund around 8.5 years ago, and we've held those shares throughout multiple short-term debt cycles and have added to our position occasionally after stock prices sold off, following some of these short-term fluctuations in the company's earnings. But overall, it's been a good position for us. It's rose over 5 times in the past 8 years for 20% annually when including the dividends. And it's another example, similar to Visa, of just the type of company we spend a lot of time looking for at GreensKeeper. They have a very strong market position that is hard to disrupt, hard for competitors to take any market share, natural tailwinds to grow their revenues, grow their earnings, and they don't require a lot of capital to reinvest in the business. So a lot of these growing earnings expand their margins and allows them to keep a relatively healthy balance sheet while doing so. So these are just 2 good examples of the types of companies that we spend pretty much all day looking for and opportunities to purchase them.
Good job. Thank you, Michael. I'll get you to come up after. As Michael was talking, it reminded me there's a book by Peter Thiel called 0 to 1. He's got a great line. It says, competition is for losers. And he's talking about capitalism. S&P Global and Visa, they're oligopolies, and we love them because they have pricing power. Michael and I just need to find 18 other companies this good and upgrade our portfolio, and then we don't need to do anything. We just sit and just watch these businesses grow. And so that's what we look for every day. If you get a sense of where we spend our time every day, it's not trading. It's taking the principles that Charlie Munger and Warren Buffett taught and just putting hundreds of companies through that algorithm. Circle of competence, do we actually understand what these companies do? Some companies we don't understand, and so we just pass. But if we can get our head around it, okay, well, is it a good business? Does it have a sustainable competitive advantage or a wide moat? And I think it's pretty obvious that both Visa and S&P Global have very wide moats. But it's easy to find the great businesses. The numbers just sing to us. The hard part is getting them with a margin of safety or buying them cheap because they're never on sale. Almost never, sorry, not never. They're rarely on sale. And so what we do is we just spend our time looking at these great businesses, and if we come to the conclusion that it checks all of our boxes except price, we simply put it on our watch list. Michael and I talk to Michelle and say, set a stock alert. If the stock goes below this price, we get an email. And that happens from time to time, and when that happens, we roll up our sleeves, we update our research to see what's happened, what's changed, and has our thesis changed? Reading, studying, analyzing, and we rarely trade. But we do trade from time to time, and I'll talk a little bit about that. And so when you apply these principles consistently, you get the outcome, which is results. So $1 million invested with us from day one would be worth $3.5 million today, despite the slight pullback over the last couple months. We've had 13 full years of investing. We were positive in 12 of those 13 years. Our one down year, 2022, we were down 4%. And it's worth mentioning that that year, the S&P 500 was down in the teens. The NASDAQ was down about 28%, and even long-term bonds were down 10. So our defensive style tends to outperform when things are really, really ugly. And when things are euphoric, like when we're in we're talking about this TikTok couple, when people are buying Bitcoin and things are going to the moon, we're just trying to keep up because we're not going to invest in garbage companies. And so historically, we've really outperformed when things are tough. We're down about 3.6% year to date. More than 100% of that is the currency. The US dollar is weakened, and we have a big US holding. But Michael and I are both pretty competitive, and we're working hard to get that into positive territory and then keep going for the rest of the year. So since inception, we've compounded at 9.7% net of all fees. And while I said that we don't trade very often, that doesn't mean that we don't trade. So the chart on the left is our portfolio composition at last year's annual meeting. And on the right, it says at the end of the last month. And you'll notice a big shift. The green portion is our US holdings, went from 84% to 68.5%. That's a big move for us. That doesn't happen very often. And almost all of those dollars went to European companies. When I looked at the portfolio the last 12 months and see where the additions were, it was Ireland, the UK, Switzerland, Denmark, France, and Canada. We've added Lululemon to the portfolio. And so we invest where there is opportunity anywhere in the West. We're prepared to invest in North America, in Western Europe, in Australia, New Zealand. We will go anywhere that respects the rule of law and where we actually understand the business culture. We have no desire or intention to invest in places where in Russia or China or India, with a stroke of a pen, the rules of the game can be changed and you can lose your capital with no redress. So we stick to good neighborhoods. And it wasn't a conscious decision to go from 84 to 68.5% of US holdings, although someone told me the other day something's been going on in the US lately. I don't know what it is, but it really stems from we go to where we find value within our sandbox, which is those countries that respect the rule of law. The last point I'll make here, sorry, I should talk about domicile. So this is based on the way these charts work is normally it's where the company is headquartered. So our Canadian holding I mentioned is Lululemon. It's based in Vancouver. It was founded there. It's a Canadian business, right? But it does most of its sales in the US. Its fastest growing market is China. So is it really a Canadian company? It is, kind of. But the point I'm trying to make is the Visas of the world, the S&P Globals of the world that we own, many of these are global businesses, regardless of where they're situated. These are high quality businesses that tend to operate around the world. And so this is a snapshot of our top 10 holdings. As I said, Michael and I, we're stock geeks. We love analyzing companies and talking about them. You'll probably be familiar with the number of names on this slide. And we're happy to bore you to tears with talking about Ozempic or Zepbound or any of these businesses afterwards. But we go deep, and we tend to own businesses for a long time. And so briefly, as I wrap up, just a firm update. We started the business in 2011. We were registered in Ontario. We then had a few clients from Quebec. We just added some more. So we expanded our registration to that province a few years ago. Just a month ago, we expanded Alberta. I had a few people in Alberta approach me to become clients. We have clients in the UK. We have a growing client base in the US. We're not yet required to register in those jurisdictions, but I can see that coming eventually. Whenever I meet with new clients, I'm asked by half of them a question: what happens if you get hit by the bus? And the other half are thinking it, they're just too polite to ask. So we're building redundancy in the business. Michael's training to become an associate. Well, he will be an associate portfolio manager probably in the next month. And a year and a half to 2 years from now, he'll be a full PM. So I'm going to do my very best to avoid buses. But Michael and I, when we look at stocks and trade, we're attached at the hip. We both have the same teachers in Buffett and Munger. He gets it. And it's just a question of time and debating names. I think he's got a long future at GreensKeeper. And then finally, one of the many projects my sister's working on is a client portal. We've always taken security at GreensKeeper very, very seriously. And when we analyze, we've got great service providers and protection and encryption, but the weak link in most situations when a client could have their information compromised is your email, frankly. Somebody getting into your email, people reusing passwords. So we've looked at what's standard in the industry. A client made a suggestion, and it was a good one, and we took it seriously. So we're going to announce the launching of a portal in the near future, so stay tuned for that announcement. As is our tradition, we're big readers, and we always hand out a book, so if you haven't picked one up, I think you're really going to enjoy this one. It's a 2018 New York Times bestseller. It's a really easy read, and it's very good. It's a practical guide on how habits form, how to create good habits, and how to get rid of bad habits. And it's based by really good science, psychology, biology, but it's very digestible. James Clear is the author. He says, you don't rise to the level of your goals, you fall to the level of your systems. So he gives you a lot of really interesting hacks or things that you can do to improve, to achieve your goals. And some of the takeaways I have is your environment, the environment you create for yourself is way more important than willpower. If you rely solely on willpower, like people that are successful set their environment up so they don't have to use their willpower. And he'll give you some suggestions on how to do that. Secondly, Michael and I try and do this with stocks, is focus on the process, not the outcome. We're trying to deliver 20% plus returns. It's hard. You can't just say, well, we want to do that. What do you need to do? You need to focus on the process. Instead of saying, I want to lose 5 or 10 pounds, why don't you say, I'm going to go to the gym 3 days a week? It's a tangible thing that you can do, focusing on the process that will get you there. And finally, I had a great line that the difference between professionals and amateurs is that the pros put in the work every day, even when they don't feel like it. Even Michael Phelps, he had days where he didn't want to train, but he made it to the gym. And so the author gives you a few things that you can do to help nudge you to put in the work every day to help you fulfill whatever your goals are. So I'm going to open it up to questions, but I had a few that came in, and I know Trump is probably going to be front and center, so I might as well address a few of them at the outset. The first one was the constant US policy changes and reversals have created uncertainty both in Canada and the rest of the world. Are the goalposts becoming more certain or set for Canada? And I guess that's more a question for our Prime Minister, Mark Carney. Good luck. I don't think Donald Trump knows what he's going to do when he wakes up in the morning, so I'm not going to try and guess what he's going to do. All I can do is look at what the administration is saying and what they're trying to accomplish and try and navigate around it. But I think it's going to be an interesting 3.5 years. And part of our investing thesis is to invest where there's rule of law. Is the rule of law at risk due to the current administration? Yeah, it's a good question. And in my lifetime, this is the most aggressive administration that I've ever seen in terms of pushing the envelope and trying to assert executive authority. And at the moment, I think that the U.S. judiciary is the only one of the 3 co-equal branches of government who is pushing back. But it moves slowly, as some of the lawyers in the room will know. And they can't enforce their own decisions. They don't have an army to make. So we're in an interesting spot. What I would say is, I think over time, every president's power wanes. He or she, or I guess it's been only he, loses some influence when the midterms come, and by the end of their term, most of their influence is gone, not all of it. So, Benjamin Franklin, when he left the Continental Congress, was approached by a woman and said, Dr. Franklin, what do we have? Do we have a republic or a monarchy? And his answer was, you have a republic if you can keep it. The founders of the United States, the founding fathers, understood how dangerous it was to concentrate power. That's why they created 3 co-equal branches of government. They structured things with checks and balances and protections. Our bet is that the republic continues to hold. Whether you like Donald Trump or not is irrelevant. I think that the US, the institutions in the US will get us through this tumultuous period in the next 3.5 years. And then the final question I got in advance was, how has your investment approach changed or evolved in light of the escalating trade war and or its potential impact on businesses? And what I'd say is, our framework has not changed at all. What's changed is we take what's happening in the US and with policy and say, how does that impact the companies that we're invested in or might want to invest in? And I'll give you a specific example. It was probably 3-4 weeks ago. Michael and I talked about this. I knew something was coming out in the US about drug pricing, high drug pricing in the US. You just knew it was coming. So we spent a day and a half looking at what can the US administration actually do under existing law to lower drug prices in the US. And Biden, under the Inflation Reduction Act, can take, I think it's about 10 or a dozen drugs, and over a period of years lower their price. Beyond that, the conclusion we came to is the executive actually doesn't have the authority to set drug prices. In fact, they're prohibited from doing so under certain legislation. But that's not the end of the analysis, because we know that the administration doesn't really care what the law is in some cases, and they're going to push the envelope. So we looked at the portfolio and we made a couple changes. We sold a few drug stocks that we thought were pretty much fully valued or we didn't like their prospects, and we rotated into another company, Novo Nordisk, that I think will be just fine. So, you know, I don't know what's going to happen in the next 3.5 years. I do know that he is exhausting. Every day it's something. You know, we exhaust ourselves thinking about what can happen, but we think about it all the time, and we're going to do our best to try and navigate around the next 3.5 years. Hopefully some good comes out of it. I hope the tariffs go away, but hope's not a strategy. We have to deal with reality, and we're going to manage the best we can. So with that, I'd welcome any and all your questions. Mr. Bussamra.
It's along the same theme as you were talking about the U.S. and I spoke about it briefly, but on the if it comes to pass, the big beautiful bill and the new tax strategy that they implement there on the dividends and sort of
Right.
capital gains taxes, is that going to? I mean, look, I think your value investing discipline is incredible. I really do, but that changes the dynamic of value investing, because now you're not looking at just the companies, but you're looking at the profits involved in that investment. Would that force you to change your look at moving some investments out of the U.S. as well, or?
Yeah, so the value of any investment is the present value of its future cash flow. So if a government is going to tax more of my future cash flow, it's going to lower the value of the business. So yes, I factor that in. The provision you're talking to, I think it's Section 866 or something. There's something in the House bill that basically says for companies that discriminate, and Canada would be labeled a discriminator because we charge it's a tax on media companies, the large media companies. So arguably the US Treasury could send a notice to the president to say they're discriminating, and they could increase the capital gains withholding rate. Currently, it's 15% under the Canada-US tax treaty. It can go up 5% a year, up to 50%. So yeah, if that happens, we'll take it into account. But the reality is most of the stocks we own have 2-3% dividend yields, and 15% of that going to 20. So 5% of that amount doesn't make a huge difference yet. Now, if it ratchets up 5% over 10 years, yeah, it's a big deal. What I'd say to you is I don't think the bill in its current form is going to come out of the Senate. But if it does, yeah, I'm going to think about it. Michael and I can say, okay, we're not going to get 85% of the dividends. We're only going to get 80 next year. So at the margin, it can change our analysis a little bit.
Thank you.
Yes, sir.
Do any of your clients ask you to buy more Canadian, especially today? I mean, go back to your slide showing the
Sure.
about
Sure.
you added year over year. You added more
Whoops.
to emerging markets, ex-Canada. Yeah, you don't own very much Canada.
We don't.
And if you're feeling like you want to support Canadian companies, I'm sure you could find some good Canadian companies to invest in deep value.
Well, I'm not deep value. We're value and compounding value. I would love to put more money into Canada. I think that Canada struggles with not having a high number of high quality global businesses. And so we're open to it. We just haven't had it. There are the Constellation Softwares of the world where I would buy in a second if it were reasonably priced. So I'm agnostic. I want to serve. look, I want to support Canada as if you want to not travel to the US or not buy US goods and services, I respect that. I have no problem with that. But at GreensKeeper, my job is to move capital within countries that respect the rule of law. I'm not going to take a nationalist point of view and say I'm only going to invest in Canada because I think it's going to hurt your returns. And when you look at the trade war, I think that Canada will suffer disproportionately if we don't find common ground with the US. And so, I wrote about this last quarter.
I just worry that, and especially with pension funds, we're not supporting our own Canadian companies.
Right.
It increases our cost of capital.
It does.
It puts us at a disadvantage. So I think that, if we bought more Canadian companies, it would help them grow.
Yeah, it would, to lower the cost of capital. To me, that's government's job, to create the tax incentives for people to invest in Canada. I don't view my view as a steward of our clients' capital to support Canada at the expense of returns or safety of capital. So if someone wants to do that, I respect it. I don't have a problem with it. That's not my mandate. And I would be happy to invest in Canada if I could find more companies that met our quality threshold, but it could also deliver an excellent return. But we look every day. We do look at Canada, and I have yet to find very many that actually crossed our bar for quality and value. Mark.
Firstly, thank you very much for the presentation from you, Michael. It was great.
Thank you.
2 questions. Back to the process, what is your maximum exposure you have to any one individual position?
Yep.
And number 2, what is your selling process? Like
Sure.
What determines a sale to you?
So our biggest position today would be about 10%, maybe a little bit more for some accounts, Berkshire Hathaway, which we trimmed because we think the stock, it's not cheap at these prices. We've been as high as, have we ever been higher than that? Like 12, 13% with Berkshire? 15 max. These on occasion, when the stock has run, has been 10%. So we tend to hold about 17 to 20 names. So on average, that's about a 5% position. If it's a high quality name that's a compounder like a Visa, I'm happy to keep letting it run, even if it gets a little bit overvalued from time to time. But our sell discipline, it depends on the quality of the company. If it's a compounder like Visa and SPGI, I hope I never sell them. If it can grow in the teens, as long as it doesn't get too big relative to its position size in the portfolio, you want to let these run. Buffett's talked about it many times, and some of my biggest mistakes in the past 14 years have been selling companies like Microsoft when I thought they were fully valued, and then watch them go 4 or 5x. We have other companies in the portfolio that I would say they're not compounders. They're either a little more capital intensive, a little more cyclical. There's a price at which there's one that's getting pretty close to where we're going to sell it and redeploy the capital. Now, anytime we find something new to buy, we prefer to be almost fully invested at all times. At that point in time, when we find, we're going to put 2 or 5% of the portfolio into a new name, we got to find places for the capital. So it depends on, my sell decision will be based on the valuation of all the ones in the portfolio, which ones are cheap, which ones are expensive, and also is it a compounder or not? And if it's not a compounder, I'm more inclined to sell it. So there's a lot that goes into the calculus, but that's at a high level how we think about it.
Hey, Mike.
Jerry.
Just as a clarification.
Yeah.
So if you have a holding and it gets to go any higher than 10% of the portfolio?
Well, it's not a hard stop, but we've had Berkshire at 15%. When I started the firm, the week I started the firm, Berkshire traded at about 1.02 times price to book. It's worth over 2 times the book. It was obvious. At that price, if it's 15%, that doesn't bother me, given how diversified the business is.
So you don't have a goal that if it's...
I could take it to 20. Under the...
Cap it at 10%.
I could take it to 20. I don't. I'm fairly risk averse.
Yeah.
You
don't have an artificial cap on any stock.
I don't, but at 10%, we definitely take a harder look at a business. Look, there are other companies. Lululemon is a 2.5% position. We looked at it the other day. They had a terrible quarter. Now, the stock's about where we bought it. We don't want to make it a bigger position. Even though I think the risk reward is there, the quality of the business, the cyclicality, the risks involved don't warrant a larger position. So it depends not just on the percentage, but on the quality of the underlying business as well. Jim.
Yeah, Michael, you said that there were a few clients that have approached you coming in and said, you know, I might want a specific holding to look a little different than you think. Have you
Yes.
done that, and can you give us a vague idea how that looks? Or how
Yeah, so I won't put tobacco in the value fund. I've stated that publicly. But some people are prepared to own tobacco personally, and so if that's what they want me to do, I don't have a problem with it. I don't judge it. So I've had people do that. I have some clients where they have multiple managers. I mean, people with a lot of money, and they've said, look, my other manager owns these names. I want you to avoid them, or give me a different mandate. And so I respect that. Most of our portfolios they own the same stocks. It's always going to be a little bit different based on when you come in. The percentages will be a little bit different. We own the Visa of Israel. It's called Shva. So MasterCard and Visa don't actually operate in Israel. There was a government monopoly that went public. They're the Visa of Israel. We own it. Some clients don't want to own Israel. And again, I don't judge. That's fine. I respect that. And so in their separately managed accounts, I just won't own it. Some companies don't want to own defense contractors. Lockheed Martin and General Dynamics are two names that we own. So for whatever reason, now the mandate has to be one that I'm comfortable taking on, making sure I can still build a portfolio. But if you have a specific ask, I'm pretty blunt. I'll say, yeah, I can do that, or I can't manage around that. We're just not for you. Because I want it to be a good fit for clients, and our clients are usually with us for a long, long time. Alan.
Excluding flavor of the month and hype.
Yep.
What's your studies and reading, which I'm sure you've done a lot of, on AI? What kind of thoughts do you have around that? And obviously Microsoft might be a nice play to AI, but what's your thoughts of that going forward?
Yeah, I'm still trying to figure out if it's going to enslave us or make, be a tool for the better for humanity. We're playing with it. I mean, we won't let it touch our models, but Michael and I, he's using Gemini. We're both using OpenAI. They're amazing. My sister was using it the other day for a project. So I think that they're going to be amazing tools to make a lot of mundane jobs better. I don't know how far it can go, and I don't think that anybody knows yet. We've got exposure through Google, because I think Google's as well positioned as anybody in that industry if it doesn't destroy search. So I'm bullish long-term on AI being a good for the world. I don't know who the ultimate winner is going to be, but I think my own view is that the large language models are going to become commoditized, and that the service providers with a lot of capital, the Microsofts, the Googles, are ultimately going to be the winners. Maybe an OpenAI, because they seem to have the ability to raise capital. But I think that these LLMs are going to become commoditized fairly quickly. I don't know exactly how it's going to play out, and I don't know how to play it, to be honest with you, Alan. If I knew who the rock star was going to be in 10 years, it's probably a good bet, but I struggle to figure out who that is. Anyone else? Okay, well, we're going to be around for a while. Help yourself to a book if you haven't taken one. It really is a good read. I think you'll enjoy it. And a drink and something to eat. Thank you for coming, and welcome any additional questions privately afterwards. So, thanks again.